So what is a derivative? Anyone with any idea of what a derivative is? Forget about the definition right now in front of you. Yes, please.
Yes, I think it's first a contract
Mhm.
between two parties.
Okay.
Uh, its price, it derives its price from an asset or any financial instrument. It could be even an entity. That's it.
That's it. Okay. We have, let's suppose, these four terms, and if I want you to explain these to me, like we have one word that we use is an instrument. Another word is a contract. Okay, and then we have security. How would we differentiate? Because you see, you often hear this about a financial instrument, a financial contract, a financial security. Any idea?
Yes, financial instruments are monetary contracts, so between two parties,
Okay,
which can be created and modified as well.
okay. How about security?
A security, I would, I would suggest it's a stock, a share.
Okay, so an instrument is something that is like, that is what we call an underlying for a derivative contract. Okay, so it can be a stock, it can be a bond, um, it can be, I mean, like, even at times an interest rate, a commodity, you know, it's not, it doesn't say financial instrument, it just says instrument. Okay, then a contract is a legal arrangement. Okay, it's legal between two parties. So for example, derivatives are not financial securities, they are legal contracts. I mean, like, they are contracts between two parties. Okay, securities, they are tradable. Okay, and they represents a claim against the cash flows or assets of the issuer. So for example, a bond that is trading in the market is a security, and it represents a legal claim against the cash flows and assets of the issuing company or government. A call contract, a put contract. Similarly, a future contract, a swap, a forward contract, they are legally enforceable. There are two parties who agree to do something. Security, on the other hand, is also a contract, okay, between two parties, because a bond and a share represents a contractual arrangement between the issuer and the buyer. Okay, however, for derivatives, the derivative contract will derive its value from an underlying. The underlying could be any instrument. If that instrument is trading in the market, it becomes a security. Okay, technically, derivatives are not security. Why? Because derivatives do not represent a legal claim against the assets or cash flows of the issuer, okay, which is a fixed claim. Remember, a bond represents a fixed claim, and a share represents what we call a residual claim. I hope you have an understanding. If you have any question on this, please ask me right now. Are we good with this? Okay. So a derivative is a contract, a financial contract that derives, okay, its value from an underlying. And I would not use the word asset here, okay? It is here, but I am deleting it because the word should be underlying. Why? Because the underlying could be a stock, a bond, it could be an interest rate like the LIBOR. It could be a stock index or a bond index, like we have the S&P 500 or the FTSE 100 index, and then it can be a commodity, oil futures, gold futures, etc. And then it can be anything like weather. How many of you know about weather derivatives? You know, we are a few people on this module, so we should be interacting rather than I are talking about it. So we have to interact, and that's very important for us. So I'll be asking you these questions, and you don't need to actually be keep muting yourself all the time. You need to participate. So how many of you know about weather derivatives? What they are? Who uses them?
I'm not sure.
Quite familiar
Okay.
with the,
Is it
with the
to do
news.
with?
Yes, please.
Is it to do with like weather-related risk or something?
Yeah, of course, it relates with weather. That's good. Anyone else? Now, I'll give you an example. It's mostly used in North America. And you know, energy companies, their sales, their revenue, and hence their bottom line, that is their net income, depends on how much gas, oil, or energy products are consumed. And that depends upon weather. So if the weather is extreme in a given year in the winter, it will mean that revenues will be high. However, if the weather is not that extreme, snow is not there that much, and you know the temperatures are a bit high, these companies will see that the demand for gas and other energy product, petrol, etc., will be low. So their sales will be low. Now, this is basically a business risk. Now, you see, this is a business risk, and I hope you have an understanding of business risk and financial risk, isn't it? Any factor that affects the sales of the company, the cost of goods sold of the company, the operating expenses of the company, not the net income. Remember, the operating income. Any item, you see, if I let me just write it here. We have to be quite clear about it. That's why I tell you that reading is very important. So have a look here. This is the income statement of a company. So sales minus cost of goods sold. And then we get with this, we get gross profit. And then from this, we deduct operating expenses. So we get operating income. OK, and from this, we deduct interest expenses. So we get profit before taxes. And then we deduct from it taxes. So we get profit after taxes. And let's suppose it is a domestic company. Let's suppose for the time being, we are saying that it is a domestic company. So it is not affected by exchange rate and any other things like that. So all the factors that will affect sales, cost of goods sold, operating income, all those factors, these include competition, regulation, suppliers, cost of raw material, cost of inputs, marketing, etc. That is also related with competition. So all those items, all those factors that will result in an adverse change in the operating income, they will be considered as business risk for such a company. And on the balance sheet, we have the asset side of the balance sheet and the liability side of the balance sheet, and equities, of course. So generally saying, all this area, the asset side of the balance sheet and on the income statement from sales to operating income, any factor that adversely affects the operating income of the company is considered a business risk. And most of it is related with the assets. So we say that business risk is what? Is the risk of being in a particular type of business. It's quite generic that I have written here. So for example, companies that are in automobile industry, their business risk is different than the companies that are in the telecom sector. The companies that are there in the mobile phone or electronic equipment segment, their risk is different than financial institutions. And even in financial institutions, insurance companies have a different business risk than commercial banks. And of course, hedge funds, for example, they have a different risk than other mutual funds. So business risk will be significantly determined by the industry in which you operate. So some industries have high business risks. For example, financial institutions, telecom have a lower risk compared to you can say automobile industry. Automobile industry has significantly higher business risk because their demand is cyclical. So business risk will be determined by the type of business you are doing, and that is related to the industry in which you are operating. And these factors mostly include competition, because the industry in which you operate will be the industry in which you operate will be dependent upon, I mean, like, will determine the type of assets you have. So on the balance sheet, the assets you keep are significantly affected by the type of business you do. And on the other hand, the financial risk will come from the liabilities and equities of the company. So if a company is 100% financed by equity, then its financial risk is zero. However, if the company has some liabilities or debt in its capital structure, then it will have financial risk. And the higher is the financial risk, the higher will be the amount of debt, the higher will be the financial risk. And the higher is the debt, the higher will be interest expenses. And interest is a fixed expense. So deducting it from your operating income will affect your profit before taxes, and it will also affect your taxes, because interest is a tax deductible expense. So you see, we now have an understanding of the business risk, which is coming from the asset side of the balance sheet, and it affects all the factors here till this point before interest, basically. And then we have the liability side and equity side of the balance sheet, which affects the interest expenses you pay, and that is affecting your overall financial risk. Any questions so far on this, please? Okay. So now for what we are doing right now, we will be mostly focusing on financial risk. And because our companies will not be purely domestic, so they will be having currency risk exposure. So we will have forex risk. Okay. We will also have interest rate risk. Okay. We will also have market risk. So these are all, and there will be also credit risk. So these are all type of financial risk that you have come across when you were doing financial risk management with Mohammed. We are not directly, managing business risk, but you can see that most of the financial risk that you will be managing through derivatives will have implications for business risk also, because and I know that the total risk of the firm is equal to business risk plus financial risk. Let me clear this, and I introduce you to another important concept, and that is, is business risk related with the financial risk? Please, I told you that total risk is equal to business risk plus financial risk. This is what I told you. But how? Any idea on this? Are you doing advanced corporate finance, or have you done advanced corporate finance in the first term? Hello?
Yeah, we did it last time.
Last time you did it, okay? So, did you do Miller and Modigliani, MM theory?
Yes, we did.
Yes.
Okay. So as per Miller and Modigliani, the cost of equity of a levered company is equal to the cost of equity of an unlevered company, okay? Plus the cost of unlevered equity minus KD into 1 minus the tax rate into debt divided by equity, isn't it? That's what the, so this is what you did there. KL is equal to KU plus KU minus KD into 1 minus the tax rate into debt divided by equity. That's what you did. Am I right?
Yes.
So what are you saying? That the cost of levered company, the cost of equity of a levered company is dependent upon the debt and equity of the company. That is the financial risk. This is financial risk, isn't it? And this is business risk. That's what we talked about. How many of you know about the Hamada equation? Anyone?
No, I don't.
Okay, so the Hamada equation says that the beta of the levered company is equal to the beta of the unlevered company, okay, into 1 plus 1 minus the tax rate into debt divided by equity. Now, this is an interesting relationship, and it tells us that you can change the financial risk, the beta of the company if you change the leverage of the company. So the beta of the company is not only dependent upon what is happening in the stock market, but it's also dependent on what is happening with the company's financial risk, isn't it? So if a company wants to change its beta in the market, it can simply change its financial risk, and the beta will change, isn't it? Because this will increase or decrease. If you decrease your financial risk, it will decrease your if you decrease your debt to equity ratio, it will decrease your financial risk. Why? Because financial risk here is a factor that multiplies into business risk and it increases. So when I wrote that total risk of the firm is equal to business risk plus financial risk, this is how you represent it here. So in a way, and you know that the CAPM equation says that the return on security I is equal to the risk-free rate plus the beta of the levered firm into market risk premium. So you can now understand how this all is related. So we are focusing here not on this financial risk alone, like measured only by debt to equity, but we will be talking about other financial risks also, market risk and credit risk and interest rate risk, as well as the exchange rate risk. So any questions so far on this? Should I move forward?
Yeah.
Okay.
Yes, please.
Okay, so you see, that's where I told you that we will be reviewing most of the concepts in finance. And if you do this module, it will help you understand a lot of the other things that you have done on different modules in finance. So we will not be using the word asset here because we will be reducing ourselves to the word underlying here. Okay, and the underlying could be anything from there to here. Okay. The underlyings, as we say, is equities, fixed income, currencies, and commodities, but they can be weather derivatives also, indexes also. Now, what are the measures of risk? For example, here, like you see, if for a stock, bond, options, how do you measure risk? Even futures.
It's measured by the volatility or the sensitivity.
So how do we measure that for stocks, for example? For stocks, it is
Standard deviation.
Standard deviation, but that will be total risk only, isn't it?
It's beta, the volatility.
Yeah. Okay. And then for bonds, it will be, and it is also beta standalone measure. So for bonds, it will be
interest.
For bonds, it will be what?
Interest rate.
No. What will be it? Now you see, this is where you see you have done portfolio, you have done risk management, but for bonds, there are two measures. One is the probability of default. How do you measure the probability of default of a bank, of a bond? Credit ratings, isn't it? AAA credit rating, AA, A. What does those credit rating tell you? They tell you about the probability of default. So the higher is the credit rating, the lower is the probability of default. Okay, and you can also calculate the probability of default. On this module, derivatives, you will learn how to use the Black-Scholes option pricing model to calculate the probability of default or the chances of bankruptcy of a company. Okay, so you can calculate the probability of default for a bond. You can also calculate the probability of default for a company also. So you will learn this through Black-Scholes option pricing model. Then there is another measure of bond risk, which is quite common and which you should be now familiar with on this module. It is called duration of the bond. Okay, not maturity. So a bond may be maturing in 10 years time, but the bond duration may be 5 years. A bond may be maturing in 8 years, but its duration will be 6 years. Duration is like the payback period of a bond. Of course, you may know the payback period, discounted payback period. So for a bond, if you consider it like what I would say as a project, so how long will it take to get back your initial investment if you buy a bond? So that is measured by duration. So for bonds, we have two measures of risk. One is the probability of default, and we normally refer to it in terms of credit rating, and the other is duration. Okay. For options, for example, we will have delta. If you read the article that I have uploaded today, it is talking about delta and gamma. So for options, we have the first measure of risk as delta, and the second measure of risk is gamma. We will be talking about these in quite detail later. For future contracts and forward contracts, if it is a stock future, then it will have a beta. And if it is a bond future, then it will have a duration. Okay. Similarly, for swaps, we will have duration. Swaps will have duration as a measure of risk. Similarly, if you go forward and you talk about any other measures, they will have specific measures of risk, and we will come across some of them as we move forward. We can't actually do all of them at the same time, but just to give you an idea of how different underlying instruments will have different risk measures. Now, this brings me to another important concept. And look, we are just at slide 1. Okay, we haven't moved forward because we need to discuss all these. What is risk? Now, I want all of you to give me your understanding of risk. Don't worry about it being right or wrong, you know.
The uncertainty associated with security.
Okay, so uncertainty. Albert says uncertainty. Samantha.
Hello.
Yeah, hello. So what is risk? Hello. Samantha, what is risk?
Hello. Can you hear me?
Yeah, I can hear you now.
Yeah. Risk is business risk or financial risk. Sorry.
Any risk. I mean, forget about the type of risk. Just if I just ask you what is risk.
So it's literally exposure to like danger, possible danger, potential danger.
Yeah, good. That's good. Okay. Vivian. Hello, Vivian. Max.
Something like uncertain when you don't know the outcome.
Okay. Nirmala.
I believe it's the exposure that you actually looking to, the amount of money that you're looking to lose. I would say to loss. Yeah.
Okay. Talembe.
Risk is a condition that exists, which we can't quantify based on the dispersion of possible outcomes.
Okay. Vivian, are you with us, please? If you can just give me an idea of what risk is. I think Vivian has just left a Microsoft team meeting open with us, and he's just doing something else. Okay, now why I'm asking you guys to actually contribute, because this is important. This gives me an idea of your learning already from the different modules and your understanding. And this is important because you see, you have already gone through quite a few modules in finance, particularly, I mean, like have you done financial risk management in the last term or doing it now?
Doing it now.
Okay. Now, you see, when you were doing portfolio management last term, you talked about risk and return. Okay. We being expert now, you know, you have an MSc in finance and investment, you're considered an expert. So you should be knowing the use of terminology. If I'm using a word or a term, I'm trying to save a lot of words when I say risk, okay, or when I say uncertainty, when I say probability of default, because when I use terminology, I'm trying to save a lot of words and a lot of paragraphs and sentences. That's why terminology is kind of like invented and used. So we have to be very careful with what we convey in terms of the meaning we have for different terminologies. Now, there are two words that we are using here, and one is, as we say, is risk. Okay, the other is uncertainty. Many of the book, even if you read the Chance and Brooks book, it says risk is uncertainty. Okay, which is, I mean, like, you know, as a layperson, okay, that's fine, but no, there is a difference between risk and uncertainty. Now, first thing is what is risk? Okay, and the next thing is what is uncertainty. So we have what we call an adverse outcome. Okay, we have an adverse outcome here also. Now, what is an adverse outcome? For example, I expect to earn 15% return by investing in Apple. So my expectation is, my expected return is 15% in Apple. But I can earn more than 15% and I can earn less than 15%. That is less than 15% and more than 15%. This 15% is my benchmark that I will use to determine whether I have earned more than or less than. Risk is earning less than what you expect. Okay, it doesn't have to be negative. So risk is not if you earn minus 5%. Risk is that even if you earn less than 15%, let's suppose even if you earn 14%, that is the risk. So adverse outcome is anything below expectation, anything below expectation. Okay, so any event that can result in I earning less than 15% is a risky event. Okay, now if I can assign a probability to it, it becomes a risk. Any event that has a negative adverse outcome possible for my expectation is risk if I can assign a probability to it. If I cannot assign a probability to it, okay, if this is not possible, then it is uncertain. Now I'll give you an example of this. When you will be doing a few things on the financial risk management, one of them is VAR, value at risk. We will also be doing it later on when we do risk management. So we say that the risk of the stock market going down tomorrow is 2%. There is a 2% risk that the stock market may go down. There is a 98% risk that a chance that the stock market may go up. Similarly, we say, oh, there is a 50% chance that Apple will be going up tomorrow, 50% chance that Apple will be going down tomorrow. So if we can assign a probability to an adverse outcome like this, like going down, then it becomes what? A risk. On the other hand, a natural calamity such as flood, earthquake, they will also have an adverse outcome on, let's suppose, the performance of a company, its share price going up or share price going down, the market going up or market going down. But we cannot assign such events a probability. So they are uncertain events because we know that they will affect badly the outcome, but we can't assign them a probability. Car accident, life insurance. Why we do life insurance? Because there is no way we can assign a probability. And nowadays it has become possible because of the actuarial sciences. There is a way of actually assigning the probability that whether somebody would, how much is the probability that somebody will live for 90 years or 80 years or 85 years. So we do that now, but generally speaking, I mean, like, it's very hard to do so. So there is a difference between risk and uncertainty. If you can assign a probability to an adverse outcome event, then it becomes risk. If you cannot assign a probability or of an event occurring that has an adverse outcome, then it becomes uncertainty. So are we clear on this? So risk is not,
Yes.
we do use risk and uncertainty interchangeably, but they are not. Okay. Most of the time we will measure uncertainty through insurance. Okay. Can you please make sure that when you finish talking, you just turn off your mic? Okay. So now we move to the classes of derivatives. So there are two types of derivative contracts. One is what we call forward commitments, and the other is contingent claims. So forward commitment is agreements in which we actually decide to settle later. Okay. So what happens is that we determine the price today and we do the settlement, okay, later. Let's suppose in 3 months time, and this is today. In contingent claim, again, we do the same. Price is set today and the settlement will be later, let's suppose in 3 months time. However, the word commitment and the word contingent are important. Commitment means that both the buyer and the seller will have a commitment, or you can say an obligation, to deliver on the contract. Like the buyer will have to pay the money and the seller will have to deliver the good. So both have the obligation to honor the contract on the due date, that is 3 months later. So both parties have obligation. In options, one party, that is, for example, the buyer of the option, and the other is the seller of the option. The buyer has the right, but not the obligation. Okay. And the seller has the obligation. Here we said both parties have obligation. Here we are saying one party has the right, the other has the obligation. So we will have a look at each of them when we discuss each individually, but just to sort of clarify what does a commitment and a contingency here means. So in a forward commitment, whether a forward contract, a future contract, or a swap, both the parties will have an obligation. They have a commitment to honor the contract, and they cannot, move away from their position on the expiration date. However, in the option, the buyer of the option, whether a call option or a sell option, has a right to do something. So if the buyer doesn't want to exercise his right, he will let the option expire. The seller, on the other hand, whether the call option seller or the put option seller, will have the obligation, and it will be totally dependent upon the will of the buyer. So if the buyer says, I am going to buy or I'm going to sell, the seller will have to take the opposite position. He or she is obligated to do so, but the buyer has the right. Is it clear now? Okay. Now, we have to also understand another important concept here, and that is the spot market and the derivative market. So derivative market is all future market. By future, I mean the settlement takes place in future. Okay. So in the spot market, what happens is that we set the price today. Okay. And we do the settlement also today. By settlement, I means delivery and payment. So not only the price is decided today, but we also buy and deliver the product today. But in derivative market, what happens is that the price is set today, okay, but the settlement takes place in future, that is later time. Okay, is it clear? Now, having said that, if I go to the spot market for gold, let's suppose, and let's suppose the future market for gold. If I want to buy 10 grams of gold today, the price is, let's suppose, $500 on the spot. So I will give $500 and I will get 10 grams of gold, let's suppose. If I want to set the price for a 3 months delivery in 3 months time, I'll go to the market and the price is, let's suppose, $510. So I will set the price at $510 today, and then I will wait for 3 months time. 3 months later, what will happen is that I will pay to the seller $510 and I will get the 10 gram gold. Now, this is the spot price today in the spot market, and this is the spot price today in the future market. Remember, this is also a spot price, but it is in the spot market for spot delivery. And this is also the spot price today, but this is in the future market for future delivery. And this is a very basic concept that we have to understand later, because we will be dealing with all this. Then another important concept is the price of a derivative contract, the price and value of a derivative contract. For a stock, you don't have anything different. So a derivative may have a price of $100 and it will have a value of. So what does this mean? For example, in a call contract, I have the right to buy Apple's share for 100. So this is the price in the contract at which I am able to buy Apple share. And this is the value of the contract, okay, where I am able to buy a call option for 2. So if I pay $2 to the option writer, I have the right to buy Apple's share for 100. So you have to keep this thing in mind, that in derivatives, we will have two things. One will be the price and the other will be the value of the derivative.